How would you say gold is viewed in Europe? And I mean, I know Germany has a solid history with gold as a safe haven. The rest of Europe, is it the same, or do you see demand in Europe sort of at a lower than it probably should be?
Well, I think you've historically had a lot of demand out of Switzerland, and now they have the most negative rates in the world. I think the overnight is certainly more than minus 50 bips. It might even be minus 1%. And most of their yield curve is negative, which actually makes holding physical gold positive carry. You can be short the fixed income or the government instrument and long physical gold in a vault and pay your storage fee and have positive carry, which I think hasn't happened maybe actually since the last time the Swiss had very negative rates in the 70s. No, you don't see really that strong demand out of the other European currencies, European countries. I think in Italy and Spain and in Greece, where they've had some problems over the last 4 or 5 years, there's been a little more demand for gold. But again, it's mostly China, India, the emerging, and I think now the U.S. is also picking up.
Sure. Well, according to the World Gold Council, I mean, demand has certainly picked up, and Gold Eagles sold out. Maple's also sold out earlier than usual. So it seems like there's an awakening.
Well, let me finish about Europe a little bit.
Sure.
Because, one thing that's happened, and so why do we have such negative rates? Even in Italy, I think the interest rate is near zero. So the Italian government is financing itself at a rate that is lower than the United States. I mean, that's something
that's hard to get your head around.
Yeah, hard to get your head around. And when you start looking at some of the charts there of the banks, you start to understand why rates are negative. Because if you look at Deutsche Bank price is below the 2008 price. Credit Suisse is below where it was in 2008. Then you take a look at the Standard Chartered Bank, and that chart you can see has an excellent correlation, the price chart, with the MSCI Emerging Index, and that is at its lowest level in over 15 years. And you can see there's a very strong correlation. There's significant problems potentially lying ahead. And the other thing, and people don't realize this, is that the European Banking Index has a 70% correlation with the U.S., a weekly correlation with the U.S. Banking Index. And so it makes me start to think, and you take a look at that chart, and it is remarkable. The EU Banking Index is essentially back to where it was in '08. The U.S. is much higher. There's a good chance, looking at this correlation, that we could go back, I don't want to be too gloom and doom, but back to the 2010, 11, 12 area, and potentially below. And I think it's hard to argue for that at this moment, but just looking at the chart sort of suggests that.
Sure. Well, the last financial crisis started in the U.S., but quickly went global.
Yeah.
Doesn't mean that something couldn't start in Europe and come to our shores.
Yeah, I mean, you can argue, I mean, looking again at the EU bank chart, that it never resolved itself. We never really had much of a rally, at least compared to the U.S. And so maybe that ends up being the driver to bring rates down to zero and negative. If you look at this other chart, the U.S. 2-year yield against the German 2-year Bund yield, you can see the correlation is, I mean, virtually 100% going back 15 years. However, you see the German 2-year now at minus 50 basis points and the U.S. 2-year near 1%. Aside from 05, 06, when rates were rising, that is the largest spread between the two. And that spread opened up in the middle of, it looks like, 14, and then in 15 it expanded. Okay. So the European Banking Index is suggesting there's a problem. The 2-year Bund yield is suggesting that there's some sort of problem, that they need negative interest rates. And both those things also suggest that maybe the U.S. banking system might have a problem. I mean, Deutsche Bank and Credit Suisse back below the '08 lows, those are two of the important banks in the world, and certainly two of the most important liquidity providers and market makers. And if they're impaired, then liquidity will end up drying up at some point. Who's going to make that? You have two major players who are taking less risk, not acting, not having proprietary positions, and then of course they're not as eager to make markets in things like currencies and bonds. Mm-hmm. For the last probably 20 years, they've been two of my most important counterparties in trading macro. So if you think that the Deutsche Bank problem is a simple one, that it's being resolved, or I just call it the entire European banking index, you can see here the Deutsche Bank 5-year CDS, which we know is a reflection of the market's perception of bankruptcy of Deutsche Bank. Now, I have no idea where we are in that process, but I do see, and it's very clear again, the chart of 5-year CDS has spiked enormously here in 2016. And again, you see the correlation with gold is almost perfect going back 15 years. And of course, it hit its peak in 2011-12, just as gold was hitting its peak. It then came down as the perception of bankruptcy of Deutsche Bank came down, and now it's spiked up again. And I think, in fact, is probably leading gold. Now, all of these things are connected. You have negative rates in Germany. You have the U.S. You have European banks potentially impaired. You have a very strong correlation with U.S. banks. And as you can see, the correlations with strong gold price have been very high over the last 5, 10, 15 years.